Good morning. This is Mark Cooter, the leader of the real estate and construction practice for Cherry Beckert. Now the top of the hour, so we're going to go ahead and get started. Want to welcome everybody to one of several series that we're going to be talking about the current economic conditions within a real estate and construction industry. Today's speaker, we're very fortunate to have, and Greg Sweeney will be introducing him in just 1 minute. Couple house cleaning items. If you are on this call for continuing education, you must answer 3 polling questions within the 50-minute period and listen for the full 50 minutes. There will be CPA certificates that will be sent out in about 10 days, so those will be following up shortly, as well as this webinar will be recorded, and as with prior webinars and podcasts, it will be posted to the CPH internet website. There will be a survey at the end of the webinar, and ask that everybody give us some feedback on how this went. And with that, I'm going to turn it over to Greg, and we'll get started. Greg?
Thanks, Mark. My name is Greg Sweeney, and I'm part of our real estate and construction industry group leadership team. And welcome, everyone. We're going to start by having a quick poll question, and then we will transition to our guest speaker. But we'll have the poll up for 60 seconds, and we'd like you to answer. How did you hear about our real estate and construction speaker series? If you could just do that. This will be the first of 3 or 4 polling questions we have this morning. One other quick footnote, if you guys have questions along the way this morning during our presentation, feel free to use the chat to add any questions. And at the end, we should have a little bit of time to answer those questions. So use the chat as a viable option this morning. Okay, and here are our poll results. Very quickly, I'll run through them. So looks like about half of us have gotten a direct email from Cherry Beckert, which is great. It means that we did our homework, and we have several current Cherry Beckert clients here or colleagues. So this is great. So welcome, everyone. I'd like to get started. For the second consecutive year, backed by popular demand, is Dr. Anirban Basu. He is an economist who founded the economic and consulting firm Sage Policy Group, which is based in Baltimore, Maryland. He's one of the most recognizable economists in the country, in part because of his consulting work on behalf of his clients, which span prominent real estate developers, bankers, brokerage houses, energy suppliers, and other professional service firms and organizations like Cherry Beckert. In addition to being an author and a lecturer across the United States, Dr. Basu is recognized as one of Maryland's top 50 most influential business leaders and has been named one of the most powerful business leaders in the Baltimore region on several different occasions over recent years. He's very visible on social media, where he shares his thoughts, analysis, and perspective. And he's here this morning to help us understand some of the unnerving economic times impacting all of us in some way, shape, or form because of our ties to the real estate and construction industry. So with that, Dr. Basu, I will let you take it from here.
Righto, thank you very much. Thank you for that very kind introduction. My name is Anirban Basu. I'm here to present about the economy today, to talk about how the economy is performing, particularly in the context of real estate and construction. I want to thank the folks at Cherry Beckert for inviting me back. It's a privilege to speak to their stakeholders and, of course, to them as well. Sometimes people will ask me, how do you pronounce that, by the way, that Cherry Beckert? And I will say, of course, it's Cherry, not Sherry, because that's how helpful I am. Now, my presentation today is entitled No Time to Buy. This is a James Bond themed presentation. You will see that theming throughout the presentation, whether you like it or not. I hope you don't hate it, but it's firmly baked within the cake. As had been noted, please ask any questions using either the chat box. There's, I think, a perhaps also a Q&A box there. And if you want to use that, that's fine too. I'll look at either one. I will try to leave some time at the end of this for Q&A. And of course, the goal is to get you CPE credits. If I can give you any useful information about the economy, well, so much the better. Now, there are many places where one could begin a discourse regarding the economy. I could talk about Russia and Ukraine. I could talk about recent financial market volatility, including the 2 up days to start the week here in North America. I could talk about, obviously, recent economic lockdowns in China. But many of these things, if not all of them, relate to something we've been talking about for many months before February 24th, when the Russians launched their invasion of Ukrainian democracy. It is the most salient characteristic of the US economy. It is the specter of inflation. So let's talk about that, because that not only characterizes our current economic environment, but this really will help determine what the next 1 to 2 years will look like economically, and therefore for real estate and construction. And I must tell you that this bout of inflation has come as a surprise to many. We hadn't experienced this, as you know, for 40 years. Somewhere out there in this great country, there's a millennial who would have said to you pre-pandemic, well, why do we even measure inflation? Why do we measure it? It's always 2%. So why do we even have to measure it? But of course, those of us who were cognizant during the 1970s into the early 1980s know that it need not be 2%. Certainly has not been 2% recently. This is your consumer price index. Much of the data I will show you this morning, parenthetically, are time series data. So you will see the more contemporary data to the right of the slide. So this is graph back to the year 2000. So there's a line at the top there that ends at the top. That's the all items consumer price index. Between September of last year and September of this, inflation in our country running at around 8.2%. And you can see how profound the growth in inflation has been. This bout of inflation, by the way, begins to manifest itself really toward the spring and summer of 2021. Spring and summer of 2021. Now, arguably the more important line here is the bottom line, meaning the line that ends at the bottom, the lighter blue colored line, which is your core CPI, all items less or minus food and energy prices. We economists occasionally like to subtract out food and energy prices from such metrics because food and energy prices are notoriously volatile, but also susceptible to non-economic influence like Vladimir Putin, as it turns out, but also natural disaster and weather. And that's running at 6.6%. But here's the thing, that inflation has not begun to subside. So there's been a lot of talk recently about us achieving peak inflation. And if you look at the all items consumer price index, there's some evidence of that. If you look at materials prices, which I'll show you late in the presentation, there's some evidence of that we've achieved peak inflation. But if you look at the core numbers, they're not so good. Inflation, in fact, seems to be broadening, and we'll talk about why that is in a moment. Now, again, this bout of inflation, which began during the spring of 2021, has come as a surprise to many. In fact, it's come as a surprise to many folks who should have known better. And why should they have known better? Because their activities actually shape economic and inflationary outcomes in our society. I speak, of course, of the folks at the Federal Reserve Bank of the United States, who have a mandate to try to peg inflation at around 2%. And they do that, they influence economic outcomes and therefore inflation, largely by shaping interest rates and also by shaping money supply in America. You can see how profound the growth in money supply has been since since the course of the pandemic, but this graph goes back to 1959. And in economics, there's a foundational equation, a fundamental equation known as the quantity equation, also known as the equation of exchange. I like to call it the equation of exchange because that's just downright sexier. Then that equation says that when you increase money supply, 2 things can happen. Either economic growth accelerates, which of course is the objective of the policymaking to try to countervail the worst effects of the pandemic, or price growth, meaning inflation accelerates. Well, what do we know was happening during the pandemic? Well, supply chain disruptions, not enough workers, not enough truck drivers, not enough port handling capacity in Los Angeles, Savannah, Georgia, serial economic lockdowns in various countries during the period of recovery. And so the supply side of the economy couldn't really deliver as much as it normally would have because of these supply chain issues. And so what had to take on much of the burden of equilibrating that equation of exchange, prices. Now, during this period, when inflation began to blossom, we had some federal open market committee meetings. And this is where the Federal Reserve fashions its monetary policy. It sets key short-term interest rates. It determines the optimal size of the Federal Reserve. Here's some statements that came out of Federal Reserve FOMC meetings when inflation begins to blossom. So if you look toward the northwest corner of the slide, the first statement is attached to the June 2021 meeting. Now, by this time, inflation, of course, has become an issue in America. And their statement is, quote, inflation has risen, largely reflecting transitory factors. Now, a synonym for the word transitory is fleeting. So the notion at that time was, look, the economy is reopened from the pandemic, or at least is reopening. We've got these lingering supply chain issues. They're going to go away very quickly. We understand there's inflation in America, but this is nothing permanent. This is transitory. This is fleeting. This inflation will go away soon enough. Please, America, don't you worry about it. In July, the statement is, quote, inflation has risen, largely reflecting transitory factors. Yes, another month has passed, America, but nothing has changed fundamentally in the analysis. This is merely a very temporary phenomenon, this inflation. So please stop sending us your emails. Please stop making nasty TikToks about us. We have this firmly in hand. By September, the statement is inflation is elevated, largely reflecting transitory factors. So your central bank took the time to change the word risen to elevated, because that matters so much. It rose during the spring of 2021, and it's elevated into the fall. But the key word here is still transitory. And by November, the statement is inflation is elevated, largely reflecting factors that are expected to be transitory. And for the first time, they're admitting we might have a problem here. We think it's transitory, but we're not quite so sure. Now, remember, they're stretching the definition of the word transitory by this point, right? It's not fleeting anymore. It's been in place now for more than a year, or more than half a year, I should say, this bout of inflation. And by December of 2021, the statement is completely transfigured. Quote, supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. By this point, the word transitory is dead, gone, and buried. But not only have they pivoted in terms of their language, they've pivoted now in terms of their policymaking. Gone is the notion that we don't have to do anything about this, that inflation is going to go away on its own. No, we're going to have to raise interest rates. We're going to have to tighten monetary policy. Now, in December of 2021, there was a conventional wisdom suggesting that the Federal Reserve might have to raise rates in terms of quarter-point equivalents 3 times in 2022. There's still this feeling that the inflation problem was not really that bad, and therefore did not need much response. The first economist of note who I heard suggested might be 4 times in 2021 is a guy named Jan Hatzius. Jan Hatzius is the chief economist at Goldman Sachs. And he says in December of 2021, I think it might be 4 quarter-point equivalents in 2022. Now, Jan Hatzius works for Goldman Sachs. His house is bigger than mine, but he does not drive a Mustang. In any case, the conventional wisdom now is that the Federal Reserve will raise rates 17 to 18 times in 2022 in terms of quarter-point equivalents. We've already seen many of those rate increases, as you know, and 12 so far, 12 quarter-point increases equivalent. So 3 percentage point increase in the Fed funds rate, for instance. The expectation is that on November 1st and 2nd, which is when their next meeting is, that they will raise rates 0.75%. And then the big debate is December, is it 0.5% or 0.75%? Well, I mean, either way, massive increases in interest rates. And that has got to fundamentally alter the dynamics of real estate and therefore construction, which we'll talk about a lot today. Now, we get a separate statement after that December 2021 meeting from a Federal Reserve chairman, Jerome Powell, says, quote, these problems have been larger and longer lasting than anticipated, meaning we were surprised. We were telling you, the American people, this is merely transitory for the better part of a year. Sorry, we got it wrong. Exacerbated by waves of the virus. Not our fault. This is Delta, this is Omicron. We're not genetic epidemiologists or virologists. We're simply monetary policymakers, and we missed it. As a result, overall inflation is running well above our 2% longer run goal, and will likely continue to do so well into next year. Well, this, of course, is next year. And they're right about this part. Inflation has been well above that 2% target. Now, I'm not suggesting to anyone in this room that the only reason we have this bout of inflation is because of money supply or monetary policy generally. There have been other factors. There have been supply chain disruptions, for instance. This is the Census Bureau's Small Business Pulse Survey. It's a creature of the pandemic, as it turns out. Question on the table here is, small business operator, in the last week, has your business had any of the following? Red line, domestic supplier delays. Now, these data only go through April, as the Census Bureau is retooling the survey, but during the final week of April, 45% of small businesses reported some domestic supplier delay. But notice, it doesn't change for many months. And that's been the most surprising aspect of the pandemic recovery period for me, is because we've been operating in this just-in-time inventory world. If you wanted it, it would be there for you just in time. But all of a sudden, supply chains around the world are not working. They're peripatetic, meaning they're shuffling around, they're shifting locations, which in the long term might be very good, for instance, for North America. But in the short term, it creates disruption to production. Now, that's a blue line there, same question. Did your business have any of the following over the past week? Foreign supplier delays, same story. So that's inflationary, because if the supply side economy is not working well, that breeds scarcity and people compete over scarce items, driving up prices. In fact, the sheer nature of the economic recovery to date has been a source of inflation. This is gross domestic product data for your eyes only, because you're the only ones here. Back to 1990, quarterly data, annualized growth rates. Now, some unfortunate complexity on the slide, not one, but two vertical axes. The blue color bars are indexed to the left-hand vertical axis, the red color bar to the right, the red color bars to the right. Reading from left to right, the last blue colored bar is the fourth quarter of 2019. It is a quarter of economic growth. The US economy has plentiful momentum going into 2020. We added jobs in January of 2020. We added 376,000 jobs in February of 2020, a perfectly respectable tally. Unemployment is at a 50-year low at that point. We shut down the economy in March of 2020. Now, March of 2020, of course, is embodied by the first quarter of 2020, here represented by the first red colored bar reading from left to right. And during that quarter, the US economy shrinks 5% on an annualized basis. Well, ladies and gentlemen, that's big news by itself. For instance, during the fourth quarter of 2008, which had been the worst quarter of our economic lives, the US economy shrinks 8.4% on an annualized basis. And of course, that was a desperately horrible time for construction and real estate activity. So a negative 5% print's a big deal. Unfortunately, this time around, it is merely the appetizer, for during the second quarter of 2020, the US economy shrinks 31.4% on an annualized basis. That's that red bar that you see slumping to the south of the slide. We lived through this. And around that time, a furious debate breaks out in the economics community. What would the initial phase of recovery look like? Would it be U-shaped, L-shaped, Nike swoosh, check mark, square root, hockey stick? It'd be a straight up V. For during the third quarter of 2020, the US economy bounced back 33.4% on an annualized basis. That red bar sliding to the north of the slide. At no point has the supply side of the US economy been able to handle that pace of growth. Demand has persistently outstripped supply. Now, true enough, during the first half of 2022, gross domestic product dips for 2 consecutive quarters, satisfying a technical definition of recession. But for the most part, the recovery has been V-shaped, and that has been inflationary, very strong demand growth. Now, we've talked about a few things here so far this morning. We've talked about money supply and monetary policy as a source of inflation. We've talked about supply chain disruptions. We've talked about the V-shaped recovery. But and part of that was driven by significant federal stimulus packages, of course. But to more fully or completely explain this bout of inflation, we need to talk at least about one other factor, and that factor pertains to the behavior or dynamics of the labor market. But before we get to that, let's go to our next poll. So the poll reads, from your perspective, how do you see the economy performing over the next year in the context of inflation/recession? So inflation/recession, how do you think the economy is going to be? Thinking about recession or inflation or both. A bit better than expected, meaning less inflation, better growth. Much better than expected, meaning less inflation, better growth. About what I anticipate with respect to inflation and recession. A bit worse than expected, and then far worse than expected. So I don't know if these responses make a whole lot of sense, but how do you see the economy performing over the next year? So look at it from the perspective of the future. Do you expect it to be a bit better, much better, about what one might anticipate, a bit worse, and far worse? And then we have this open right now. Again, the goal of these polls is CPE credits, but I'm interested in the response. Try to answer it from a forward-looking perspective. Do you think it's going to be a bit better than many people expect, much better, about what many people anticipate, you anticipate, a bit worse or far worse? Read the question, should have probably been backward looking. In any case, do we have the responses here? Okay, here we go. So you expect things to be a bit worse than expected. So the market has a certain perspective on things, and maybe some of this bad news is not yet built into the marketplace or into people's expectations. I want to come back to this later on in the presentation, but now let me talk about that labor market dynamic. So one of the things we get from the federal government each and every month are data regarding available job openings. Now, in construction, we have 407,000 available unfilled jobs in America. Economy-wide, according to the most recent data from the JOLT survey, the Job Openings and Labor Turnover Survey, as of August, we have 10.1 million available job openings. Time series data here, so the more contemporary data to the right. But notice that your eye will first note that the number of job openings is falling. Evidence that the economy is slowing. Okay, that's true. But if you look at it from a lengthier period, from a long-term perspective, 10.1 million available job openings is still a massive tally. I mean, before the pandemic, when the economy was very strong and we had that 50-year low in unemployment, we had about 7 million available unfilled jobs in America. So why do we have so much scarcity in the labor market? Well, of course, again, we've had that V-shaped recovery, a lot of demand for workers, whether at retailers or hotels or airlines or other places that have had a challenge staffing up fully, construction firms, of course, manufacturers. But one of the other reasons is that labor supply is much smaller than it was or would have been but for the pandemic. So, but if the labor force in terms of its growth had followed the pre-pandemic trajectory, would have a much larger labor force than we do right now. I can make that statement in many different ways. Let me use percentages. This is your US labor force participation rate graph back to 1950. This is the fraction of working age adults who are either working or looking for work in America. As a side note, how rapidly labor force participation grows in this country during the late 1960s through the 70s and 80s. This is a period during which America, broadly speaking, is moving from single income households to dual income households. Some of you might remember the television show from the late 1980s, 30-something, a very popular show for 4 seasons. It focused on these dual income household members in the Philadelphia suburbs. So because they were working so hard on their careers, they didn't have enough time for each other, they did not have enough time for dry cleaning. It was not a particularly deep show, as it turns out, but featured a very good-looking cast, along with actor Timothy Busfield. Now, this pattern of rising labor force participation ends roughly with the turn of the millennium. You can see it begins to slide thereafter for a number of reasons, including retiring baby boomers, but also because young American men are not participating in the workforce the way they once did historically. What they're up to, no one quite knows. Now, that said, the labor force participation rate is growing as we approach the pandemic. The economy is very strong, wages are rising, lots of job openings. And then at pandemic eve, we have a labor force participation rate of 63.4%. It then plunges to 60.2% as 8 million people leave the labor force for various reasons, including fear of infection. It has since bounced back to 62.3%, but nowhere near where it was pre-pandemic. And one of the industries most affected by this is construction. Why? Because construction workforce tends to be older, and during the pandemic, we saw a lot of baby boomers retire earlier than anticipated, particularly during the very early stage of the pandemic. These were many of our most skilled construction workers, skilled tradespeople, who had been refining their skills over the course of decades. They often entered the skilled trades or made their pathway into the skilled trades upon high school graduation. They learned their love of working with their hands and minds at the same time and heavy equipment. They're in shop class in high school. Shop class typically taught by someone with enormous arms wearing a Rush t-shirt and driving a Trans Am. At least that is my recollection. But that kind of person has been weeded out of the classroom. So young people don't have the exposure to the skilled trades that the older generations did. So too few people entering the skilled trades, too many people retiring, you have scarcity, and of course, that creates all kinds of issues. Now, there's another factor at work here, beyond labor force participation. What people want out of the world of work has also changed over the course of the pandemic. Good Hire is a background check company out of Redwood City, California. They recently conducted a survey of 3,500 Americans, and that survey indicates that 68% of Americans would choose remote work options over in office or at the job site work. They prefer to work remotely, these Americans. Cat, coffee, computer. That's enough for a fulfilling life for them. They don't want to commute. They don't want to be with their colleagues. They do not like their colleagues. A separate survey finds that 57% of Americans find their colleagues to be annoying because they overshare, they take credit for one another's work, and of course, they interrupt during conversations, which can happen during Zoom meetings, by the way, and typically does. Nonetheless, there's this general preference for remote work. If you look at the third bullet on the left-hand side, it says 74% of Americans believe that companies not offering remote working arrangements will lose major talent in the workforce. And of course, 100% of the people answering that question view themselves as major talent. But the point is, there's this general preference and expectation that people will be allowed to work from home, at least occasionally, and they value that flexibility. But of course, for construction, manufacturing, brick and mortar retail, hotels, restaurants, where service must be delivered at a job site, typically speaking, this creates all kinds of issues for recruitment and retention. So how do employers deal with this scarcity of human capital? Well, of course, they pay more. This is your employment cost index for private sector workers. Construction wages, as it turns out, not just this is for all private sector workers, but construction wages rising at their fastest pace in about 4 decades, no surprise. This is 12% change. So the line that ends at the top there, that's your wages and salaries growth over the past 12 months. A separate measure called average hourly earnings, which indicates that also average wages have been rising on an hourly basis at around 5%, perhaps a bit more than that recently. The lower blue colored line there is benefit cost increases. You can see where that's been where a lot of the more recent inflation has been, as employers try to more finely tailor their compensation packages to what their employees actually want in this period of the Great Resignation, with about 4 million people quitting their jobs each and every month recently, looking for better jobs, higher pay, whatever it happens to be, more flexibility. But this is misleading, by the way, this lighter blue colored line. Why? Because it's not all encompassing. What do I mean by this? Well, there are certain benefits that employers can offer employees that would not be reflected here. I'll give you an example. My firm's name is Sage Policy Group Incorporated. We're an economic policy consultancy based in Baltimore, Maryland. We have 12 employees, including myself, pretty small firm. We also have 2,400 square feet of office space leased in downtown Baltimore. And all of our workers are working remotely. Most of our staff are comprised of, or is comprised of millennial economists and analysts, millennials. They're mostly 30-somethings on our team. Now, I have said to them late last year, let's go back to the office. Let's collaborate, let's innovate, let's talk about the client experience with respect to writing reports or conducting presentations like this one. Let's improve that experience for folks. Let's go back to the office, plus I'm paying rent. And I need to justify that. And these are millennials. So they said to me, boss, because they don't call me by my name because I'm not sure they know it. So, but boss, that's a very fine offer. Thanks for considering us. It's not going to happen. Now, they're millennials, so they don't communicate quite in that fashion. They simply didn't show up. But the point is that I'm offering our staff the opportunity to work remotely, but that would not be on this slide. First of all, because we're a very small firm, but also because there's no monetization there. There's no transaction there. So in fact, if you take those kinds of factors into account, flexible working schedules, for instance, the cost of workers actually has gone up much more than this chart would suggest. That red line there, the sandwich line, is overall compensation increase. Despite rapidly rising compensation costs, employers continue to hire aggressively. This is net change in US jobs on a monthly basis back to May of 2020 when the economic recovery began. If you look at the most recent month here toward the right, September of 2022, America adds 263,000 jobs, a perfectly respectable tally and above the consensus expectation. So some people will say, oh, we're already in recession. I don't think we are, because how do you square that with all the jobs being created, low unemployment? In fact, unemployment fell last month to 3.5%. Retail sales, other things we could talk about, consumer spending has been quite strong. None of these are indicia of recession. And because we've been adding jobs so regularly and in fairly high totals, we are now more than fully recovered in terms of the total number of jobs supported in America. We have about 500,000 more jobs supported in the US economy than we did pre-pandemic. Let's break things out regionally now. This is employment growth for the 25 largest metropolitan areas in America in percentage terms, February of 2020 versus August of 2022. So why February of 2020 as a starting point? That's the last month before we shut down the economy. Why August of 2022? That's the last month for which we have sub-national data, for instance, metropolitan area level data. So this is a partially mistitled slide, as there are some regions of the country that have not added jobs over the course of this pandemic era, but many have. And at number one, Dallas, Texas. Now, the governor of Texas, a guy named Greg Abbott. Greg Abbott, one of his governors, is very aggressive in keeping the state's economy as open as possible, even during the worst of the pandemic, hewing as close to normalcy as possible, trying to retain as much economic momentum as possible. I'm going to cherry pick here. At number 4 is Atlanta, Georgia. That's Governor Brian Kemp of Georgia, presently running for re-election. First governor of the country to reopen his economy. Happened on April 20th of 2020. At number 5, Tampa. That's Governor Ron DeSantis of Florida. Governor Ron DeSantis, again, one of his governors, very aggressive in keeping the state's economy as open as possible even during the worst of the pandemic. If you've ever met the governor of Florida, probably best if you're not wearing a mask. He does not like it. I'm told it's worst day of the year, at least by his staff. They tell me Halloween. And at number 6, Phoenix, Arizona, that's Governor Doug Ducey of Arizona. Again, one of these governors very aggressive in keeping the state's economy as open as possible, especially with respect to neighbors like California and New Mexico. So some governors focus on that, keeping economies as open as possible. Other governors much more fixated I got a question here. What about North Carolina? North Carolina had restrictions for a long time, and yet North Carolina is arguably, and this question comes from Riaz, that's a good point. North Carolina has arguably one of the most dynamic, if not the most dynamic economy in the entire country. Charlotte is a banking center. And during much of the pandemic, and of course now headquarters to Truist, for instance, but other banks as well. And so banking got a big push because there was so much lending taking place. So, finance was very much active during the pandemic. So these data are shaped by more than simply economic lockdown policies, but I will make the case that the degree to which economies are locked down has a lot to do with how these data have turned out. But there are other factors at work, including the composition of economies. I'll talk about the housing boom in a moment, which, to the extent that Charlotte is a major mortgage-making center, which it is, that would have tended to benefit economic activity there. But every one of these regions has a different story. So San Antonio has a lot of military bases, for instance, and San Diego. Well, let's talk about California now, because at number 25, you see the region that's performed the worst. That's lost 2.3% of its pre-existing base of jobs. The metropolitan area known as Los Angeles, California, at number 24, losing 1.7% of its pre-existing base of jobs, is San Francisco. You can also see San Diego at number 18, a relatively weak performer. Why? Well, who's the governor of California? It's the wickedly handsome Gavin Newsom. Himself would be a Hollywood actor, utterly gorgeous gentleman, as it turns out. Last governor of the country to reopen his economy. Now, you might ask me the question, Anibal, why does this matter? Why are you bringing this up? And to explain my perspective on this, I will turn to the parable of Humpty Dumpty. So Humpty Dumpty was an egg, according to contemporary lore, an egg, according to ancient lore, a siege cannon, as it turns out, but according to contemporary lore, the modern storytelling, an egg, but an egg with special characteristics, arms, legs, a face. Now, one day Humpty Dumpty is sitting on a wall, minding his own business, public property, by the way, no trespass. And somebody comes up behind Humpty Dumpty, probably Vladimir Putin, and pushes him off that wall. He's an egg. He breaks. He cracks. Now, all the king's horses and all the king's men come rushing to put Humpty Dumpty back together again. I'm not sure why the horses were there. They would have only made matters much, much worse if you can visualize this. But even the men could not do it. And my point is the economy is akin to an egg, and it was broken. It's been hard to reconstitute that egg, meaning the economy, in the context of labor force dynamics and supply chain issues. But some regions of the country were less cracked than others. Dallas, Atlanta, Tampa, Phoenix, then Los Angeles, New York, San Francisco, Chicago, Detroit. So these results, by and large, prevail, though there are, again, other factors at work here. So again, that shapes the data. Now, this next slide, same 25 major metropolitan areas, but instead of employment growth in percentage terms, now this is a more important slide because this is unemployment rates. And here's the problem, ladies and gentlemen. These rates are too low. And you say to me, Anibal, that's crazy talk. We love low rates of unemployment. We want Americans to be able to find jobs when they're looking for one. Oh, I agree with that. I totally agree with that. Unless we have 10.1 million available jobs we're trying to fill, 407,000 in construction, and we have raging inflation. Because the Federal Reserve looks at these data and says, oh my goodness, these unemployment rates are way too low. I can't have Minneapolis sitting at 2.1%. That's inflationary. There's almost no one left to hire. You never get to 0%. because people are graduating from apprenticeship programs or high schools or colleges and entering the labor market. So you never get to zero because job search takes time under the best of circumstances. No, I mean, these unemployment rates are too low. And what the Federal Reserve is thinking is we need to shatter this equilibrium. We can't have a red hot labor market and get back to 2%. It gets back to that core inflation discussion, that 6.6% year over year number. At the beginning of this episode, a lot of the inflation was because of supply chain issues, right? Oil prices take off and steel prices, softwood lumber prices, so on and so forth. But now, of course, energy prices generally have been falling. Or, oil prices have been in the mid 80s this week. Natural gas slipped below $6 per million BTU. Steel prices have been falling off their peak earlier this year. Softwood lumber prices are no longer at their peak. Copper prices are no longer at their peak. I believe they've been falling since about February. It's not about the supply chain issues as much as it used to be. It's more about the fact that workers are more expensive, and that affects every segment of the economy, including construction. And so the inflation is coming largely now from a wage price spiral. So the Federal Reserve knows it has to break that equilibrium. What does it mean for the segment in which we have most interest today? Let's talk about that now. But before we do that, let's go to our next poll. Do you plan on acquiring, constructing, or significantly improving any real estate in 2023? Do you plan on acquiring, constructing, or significantly improving any real estate in 2023? Yes, no, unsure. And again, if you have any questions, please feel free to use that chat box. Already one of you has, and I'll be checking that periodically, episodically, and I'll certainly try my best before the hour is over. We have about 25 minutes left in this presentation to answer those questions. So do you plan on acquiring, constructing, or significantly improving any real estate in 2023? Yes, no, I don't know, or unsure. We'll wait for those results to pop up magically, and we'll talk through those. Plan on acquiring, constructing, or significantly improving any real estate in 2023? Yes, no, unsure. I think we're supposed to, for CP purposes, keep the poll open for a full minute. So do you plan? Yes, 65%. Hey, you're moving forward. And of course, a lot of people in construction will be delighted to hear that. 27% said no, 8% unsure. So let's talk about some of these things, shall we? Let's talk about construction, the segment in which we have most interest this morning. Now, I'll start with this part of the story residentially, then move to non-residential or commercial. So again, we started this discussion by talking about the Federal Reserve, started talking about interest rates. That was the right place to start, by the way, I think, inflation and interest rates. Here I'm going to show you two interest rates of interest, the 30-year fixed mortgage rate in blue and the 15-year fixed mortgage rate in red. You can see that if you look for the right slide, that during much of the pandemic period, mortgage rates at record lows. You can also see the revenge of mortgage rates, as mortgage rates are now at their highest level since the year 2002, so 20 years. So at the beginning of the year in January, the average 30-year fixed mortgage rate was 3.22%. As you can see here, it's now screaming towards 7%. And in fact, I think we received some recent data that suggests that it has crawled even higher towards 7%. And in some of the parts of the country probably is above 7%. So that's where we are. Now, look, until about April, this housing market could be described as frothy, red hot. I'm an economist. I'm in the business of forecasting. I do not like to be surprised. I do not like to admit being surprised, including in front of an audience like this one. But I have been surprised. Not by the fact that home prices have risen during this public health emergency, mind you. I thought that would happen given record low mortgage rates, but also the fact that we've had this desire for housing, given that people want more room for home offices, home gyms, they're just spending more time at home generally, could work from home, all these factors. So I thought that home prices might rise, but I have been surprised, I will admit, that home prices rose as far as they did. Again, during a public health crisis where many people lost their lives and many others have had their health impacted from a long-term perspective. But this is the S&P Case-Shiller U.S. National Home Price Index. Again, you can see during much of the pandemic period how profound the increase in home prices has been. You can see toward the end of the series, the brakes. Home prices are no longer rising. And that's what happens when mortgage rates take off. What does this look like, by the way? Money supply, right? Money supply was growing during much of the pandemic, and now the Federal Reserve has flatlined money supply growth, or helped to flatline that growth, and the home prices have followed that precise trajectory. And many people will say to you, looking at a line like this, they'll say, oh, straight up bubble. This is 03, 04, 05 all over again. And for the most part, they are dead wrong. This has very little to do with 03, 04, 05. Remember that period in economic history was the most salient aspect of it, arguably? It was flawed lending. That was your subprime mortgage. That was your no document loan. Look back at the historical data and see how many Americans missed their first mortgage payment back then. Never made a mortgage payment. Got the mortgage, never made a payment. That's not sustainable. And in many cases, builders, home builders, try to meet that artificially elevated demand. That house of cards had to tumble, and you can see from the price action it does. It's about 15 years ago. But this is different. If we have a disequilibrium in the housing market, it's that we have too few homes for sale. And as far as I can tell, lending centers have been fairly disciplined, at least relative to what they were, let's say, 16, 17, 18 years ago. This is the inventory of unsold homes, vacant housing units for sale. So look how much we had available for sale back in 06, 07, 08. As the lending markets are shutting down, as more people are finding their way into mortgage delinquency. Right now, if you look for the right of the slide, we have very few homes available for sale. Now, one of the things I want to do for you as I move toward the tail end of this presentation, I want to show you a number of leading economic indicators because I want to pivot from a discussion of what's been happening to a forecast. I will give you my forecast. And the goal of this webinar is not for you to believe my forecast or not. That's irrelevant. The job here is for me to issue spot for you to help you refine your own views of what the economy is likely to bring and what that means for your enterprise, for your activities. So here's a leading indicator. It's U.S. residential building permits. That's a leading indicator because if you're a builder, you've got to pull a permit before you build. The segment I'll focus on first is the red segment. That relates to the construction of single unit structures. That's your townhomes and single family homes. Look how much we're building back in 03, 04, 05, during a period of flawed lending, artificially elevated demand for housing. Again, if I'm a home builder, I don't really care if people pay their mortgage, do I? As soon as I leave the settlement table, I am done with that transaction. But of course, this dynamic ushers forth the Great Recession, the global financial crisis, the foreclosure crisis that lingers for many years. And for many years thereafter, we don't build many single-family homes. Now, even during the boom in housing demand, more recently, during the pandemic, housing supply was truncated by elevated softwood lumber prices, a lack of workers, a lack of components like garage doors. We don't have enough housing because something else is happening underneath the surface. In fact, it's happening on top of the surface during this period of subdued home building, and that's demographics. In particular, the millennials are coming of age, our most populous generation. Ask yourself, what is the most common age in America this year? 30 years old. We have more 30-year-olds running around than any other age. What's the second most common age in America? 31. Third most common age in America? 29. 5 years ago, the most common age in America was 25. What do 25-year-olds do? Mostly weed. But they might rent an apartment, which lines up neatly with the apartment building boom that we saw during the previous decade. Now they're of home owning age. They're of household formation age. We'll have a phenomenal number of weddings this year. Now, part of that is catch up from the pandemic, of course, but it's also demographics. Now, some young people, they're together, but they don't get married because they're not into that. And they don't necessarily have kids because they're not into that. But they have pets that they treat like children. So they're looking for a new place to live, and they want ownership in many cases. But they can't find a home that they can afford or want. Inventory is low. And mortgage rates, of course, make affordability that much more challenging, rising mortgage rates. So what do they end up doing? They end up renting for lengthier periods. The blue segment here is multifamily construction, or related to multifamily construction, 2+ unit structures. That's what the strength is. And I think that would be one of the strongest segments in construction, even if we enter a deep recession, because people have to have a place to live. And all things being equal, higher mortgage rates are good for multifamily, at least the apartment part of multifamily. This also includes condominiums, but we don't see that much construction of that right now. So in any case, that's the residential story. And so home prices probably are going to fall a bit more going forward. That's true. And people say, oh, Boston was wrong. It is a bubble. It's true. Prices probably got ahead of their skis. There was probably a bit too much euphoria. And again, that's what happens when mortgage rates go from 3% to 7%. You would expect to see some retrenchment in prices, and that's what we're going to experience. And remember, the Federal Reserve is still tightening monetary policy. Now, this next leading indicator pertains more to commercial real estate. Commercial real estate. This is the Architecture Billings Index. Donald asked the question, in a recent meeting discussing the Greater Hampton Roads region, so we're talking about Virginia now, it's a beautiful region, Norfolk, Virginia Beach, so on and so forth. We were informed we were 53 out of 53 statistical areas on growth charts. What's your opinion of why that is? Look, I think it's actually a good thing in some sense, Donald, because some regions had bigger bubbles than others. So, in Austin, in Tampa, to a certain extent in Orlando, and some of these, Phoenix, Arizona, Boise, Idaho. We had these even more rapid run-ups in home prices, which have made those home prices even more susceptible to higher mortgage rates, right? The higher you climb, the further you can fall. So I'd have to dig deeper into understanding why it is that the Tidewater region of Virginia has not generated even more home price increase. But I got to tell you, that leaves the region less vulnerable to what's to come, which is to say some retrenchment in home prices in much of the country. My region of Baltimore, also, we did not see a big boom in home prices. No one believes in Baltimore. And of course, when the Ravens are playing the way they are, nor should they. But the point is that also means that we have less downside risk in the face of these much higher mortgage rates. Now, as I say, this next slide will pertain to commercial real estate, this next leading indicator. This is the Architecture Billings Index. And it's a reflection of how busy architects are. So if you look at that 50-yard line running west across that slide, and if it were actually a 50-yard line, there'd be a Ravens fumble on top of it, but set that aside. Any reading above 50 means that architects are busier this month than they were last month. So the last reading was August of 2022, 53.3. Architects were busier in August than they were in July then in June, May, April, so on and so forth. They're pretty busy. Lots of design work taking place. And notice, a lot of you said that you're moving forward with construction projects over the next year. But here's the thing. Sometimes the economic fundamentals are not as strong as we would like to accommodate new construction, for instance, right? So the notion here is if architects are busy upstream, contractors will be busy downstream. That's sort of the notion as a leading indicator. But when you've got situations like office markets that are struggling, this is the US office vacancy rate. Workers are still not coming back in huge numbers. Maybe they're starting to come back in Manhattan with respect to those investment banks that pay so much money, and CEOs can actually demand that people come back to the office. But in many cases throughout America, people have been very reluctant to go back to the office. They like the flexibility. And with the labor market so strong, with 10.1 million available jobs, if one employer won't offer one flexibility, the ability to work at home, there might be another one who will. So, there's this, and generally speaking, I would say commercial real estate is weak. One of the things that we saw in 2020, during a time of tumult and lockdowns, was we saw a wave of retail bankruptcy. So we saw the likes of Pure & Imports, True Religion, Neiman Marcus, JCPenney, J. Crew, GNC, Lord & Taylor, Brooks Brothers, Francesca's, Guitar Center, all go bankrupt. And often with retail bankruptcies come attendant store closures. So no surprise, when you look at vacancy rates in American malls, pretty high. And of course, many malls will probably falter in the next 5 years, stop being shopping centers, which creates all kinds of opportunities for adaptive reuse, by the way. We often refer to malls as town centers. So they're very well situated for, to become mixed use or affordable housing or outpatient medical centers, data centers, fulfillment centers, whatever they're going to be, but all kinds of possibilities there. So that'll be a source of economic activity, mall redevelopment in the future. But for right now, many of these malls are operating as malls, and we probably have enough malls in this country for the most part. So again, this weakness in commercial real estate dynamics also impacts commercial real estate, or I should say commercial construction volumes. This is hotel occupancy. The last three bars are 2019, 2020, 2021. Admittedly, 2021 was a year of partial recovery, and admittedly, leisure travel's come back with a vengeance, but business travel, not so much. And if you're a business, you're a profit maximizer, because that's what the owners get. They get the profits. But to be a profit maximizer, you must be a cost minimizer. And one of the ways to cost minimize is to send fewer people on trips. Less hotel room night charges, fewer airfares, less gasoline, whatever it happens to be. Less time out of the office or in the home, whatever it happens to be. But so there's some weakness in terms of commercial real estate. And indeed, there are 16 categories of non-residential construction spending in our country. All are listed here. And these horizontal bars represent the percentage change in construction spending for the pandemic period. So February 2020 versus August of 2022. If you look at the bottom of the slide, the worst performer here is lodging. We built a ton of hotel rooms in this country just before the pandemic. The 5 years before the pandemic, a wave of new hotel rooms. We don't need as many. Construction is down. Office above that, you see that? Now, this is misleading, that negative 12.4%, because the office category also includes the construction of data centers. Well, data center construction has been fast, furious, fabulous. It's really traditional office space is struggling economically. Now, if you look toward the top, you can see some publicly financed categories. Often public sector financing is involved in water supply, for instance. Sewage and waste disposal. Conservation development is largely flood control, for instance. But you also see manufacturing. So this reshoring story is real. The supply chain story is real in the United States of America. More and more manufacturers deciding, I'm bringing my supply chain back home, or I'm going to keep it here in the first place. So Intel's big announcement that's going to invest in the Columbus, Ohio metropolitan area, Micron's announcement investing in upstate New York, and many others. So we've been putting much more money into manufacturing facilities. You will continue to see that going forward, though obviously a deep recession would interrupt that momentum. And then the commercial category includes, among other things, a fulfillment center construction. So that's your warehouses, and obviously a backbone of the e-commerce economy. And the healthcare I expect to be an ongoing source of strength for contractors as well, even if we head into a deep recession. Now, there's something else happening here. So sometimes a developer will say, or a project owner, look, I know there's these macroeconomic issues. I've heard Basu and other economists talk about that. I'm not so worried. I think my project is beautiful. It's going to be well situated, location, location, location. I'm moving forward. But here's the problem. So the project is now put out for bid. And now the bids come in, and the project owner looks at the bids and says, hold up. Are these numbers for my project? Because if these numbers are for my project, they don't look anything like my pro forma, and my pro forma doesn't pencil out if these are the numbers. And of course, one of the exogenous shocks in construction has been, it's an inflation measure, inputs to construction producer price index data. So this is a reflection of how much more producers of or providers of construction inputs are receiving this year compared to last year. So what this says is over the past year for which you have data, September of last year, September of this year, materials prices up 16.3%. I can break this down for you more finely. This is construction materials producer price index data. So 12-month percentage change in some of these prices that construction firms are paying. Natural gas up 107%, crude petroleum up 29%, concrete, which typically rises 2 to 3% a year, or 14.3%. So yes, the Architectural Billings Index is saying, oh, contractors should be pretty busy because we've been busy designing projects for a long time. But when you look at the GDP data, the gross domestic product data, and look at non-residential fixed investment in structures, now this is inflation adjusted, I don't see any sign of recovery there. Do you? I don't see it. I don't see it. Okay, enough of that. I hope to this point that you have enjoyed this James Bond themed presentation. My name is Bond, Ani Bond, and I'm about to give you the forecast. Before I do that, let's go to the next poll. Are you going to be refinancing any projects or making any changes in how you finance new projects in the year ahead? Are you going to be refinancing any projects or making any changes in how you finance new projects in the year ahead? Yes, no, don't know, meaning unsure. Are you going to be refinancing any projects or making any changes in how you finance new projects in the year ahead? Yes, no, unsure. And then we will finish off this presentation, which has about 7 minutes left. So we'll wait for the responses here. Are you going to be refinancing any projects or making any changes in how you finance new projects in the year ahead? Let's wait for those results. It should be very exciting. And of course, the most exciting thing here is CPE credits. I've not mentioned that before. CPE credits. Oh, here we go. Yes, 32%. No, 52%. No, because why would you refinance when you've got such higher cost of capital? Right? If you've fixed your borrowing, then this is not the time probably for many people to refinance. Now, the yes says 32%, so that might be a case where I have to refinance, right? My financing is terming out and I have to refinance. And unsure, 16%, and that might be simply, I wonder how interest rates are going to move going forward. So as I said, I hope you've enjoyed this James Bond theme presentation. Let's go to some further leading economic indicators and close out with a forecast for the economy during the year ahead. Now, various leading indicators here. Here's consumer sentiment from the University of Michigan. How do Americans feel about the economy? Basically is the question here. They're miserable. Americans are miserable. And what has the most miserable? Inflation. That's why they drive angry, by the way. You're wondering, why do people drive so angry? Because they're angry. And the number one factor that has them angry is inflation, right? 11.4% increase in food prices over the past year, and rent price increases, so on and so forth. Well, again, it's a reflection of the strength of the multifamily marketplace, the fact that rents have been rising, though probably the growth in rents has been slowing more recently, but nonetheless, over the last year, certainly significant growth in rents. But that doesn't make consumers happy in their role as consumers. I got to tell you, small businesses are also not very happy right now. This is the National Federation of Businesses, National Federation of Independent Businesses Index of Small Business Optimism. Question: Small Business America, is it a good time to expand your business over the next 3 months. And in September, only 6% said yes. And mind you, many of them would like to expand, but they can't find workers. They can't afford workers. They face equipment delays and shortages. They face higher input prices. So is it a good time to spend? No. So consumers are saying, we're not happy about the world. Businesses are saying, or at least small businesses, we're not happy about the world. So consumers spend their time talking to consumer confidence service, saying, I'm very angry about, the midterm elections make me nervous, and Russia and Ukraine, and national debt above $30 trillion, and all this inflation. But I can't talk any further about these issues with you, sir or madam, because, hey, I'm going shopping. This is U.S. manufacturers' new orders for consumer goods. This is orders, and you don't see any real indication here that the consumer is pulling back. And you can't have a recession unless the consumer willingly participates. And with that, final poll. Are the current economic conditions going to alter your business strategies looking ahead to 2023? Poll number 5, are the current economic conditions going to alter your business strategies looking ahead to 2023? Yes, no, I don't know. Yes, no, unsure. Yes, no, unsure. I believe this to be the final poll, by the way. But poll number 5, all these are necessary for CPE, as it turns out. It's the constraints under which we operate. So I'll wait for this poll to close, and then we'll summarize this. Are economic conditions going to alter your business strategies looking ahead to 2023? It's really a fine question to ask. Yes, no, unsure. Yes, no. So we'll wait for, here we go. Here come some results. Yes, 63% say, yeah, I'm responding to the economy because I am alive. 22% say no, because I just don't care anymore. And then unsure means 16% saying, I don't care, and I'm not sure. I don't know. But anyway, the point is most of you are going to be responding. So let's talk about this outlook, shall we? So I've shown you a number of leading economic indicators, and some of them are actually quite positive, including this one on orders for consumer goods. There is some weakness in orders for durable goods because automobile sales have slumped or begun to slump a bit. You might have recently received a call or an email from a dealership you've bought from before saying, hey, are you interested in selling your car so we can sell you another one, that kind of thing. Because I think that these higher borrowing costs, of course, that started to impact the demand for certain big ticket durable goods. But by and large, consumer orders are still high, and we're about to march into the holiday shopping season. Actually, there's actually some suggestion that the supply side of the economy has also begun to improve. This is the Philadelphia Federal Reserve's Business Outlook Survey. The question on the table is, over the next 6 months, do you, Philadelphia regional manufacturer, expect delivery times to fall? So you see the zero line through the middle of the slide. Any reading below 0 means delivery times expected to fall. So you've got pretty strong demand coming from the consumer. Supply side economics are starting to improve, at least relative to December of 2021, despite Russia, Ukraine, Chinese economic lockdowns. So you put demand and supply together, that sounds actually pretty good. And then you look at the Conference Board's index of leading economic indicators, and this reading has been falling recently, but still overall a high reading on the leading economic index suggested that, hey, next few months could be good for the economy. And I think that that's correct. That recession is not imminent, which takes me to my final slide. If you're an economist, you only forecast twice. I think this will be a year of growth. I think it has been. Again, GDP during the first half of the year was negative. I get that, but nonetheless, summer travel, retail sales, job growth, unemployment trends, job openings, all of that suggests that this has been a year of economic progress, despite all that inflation. But 2023, I think, will usher forth a quite deep recession. So watch for that. The economy will remain unbalanced. On top of that, with supply struggling to keep up with demand. Obviously, we've got Ukraine, Russia, Omicron, China, Europe, the energy crisis there, hampering the recovery on the supply side of the global economy. My principal consideration here, by the way, is the Federal Reserve Bank of the United States. Right? They're trying to engineer this soft landing. They're trying to slow the economy, weed excess inflation out of the economy without driving us into recession. Prior to this rate tightening cycle, we've had 8 others since the early 1980s. 6 have ended in recession. Even the Cleveland Browns have a better record than that. And this Federal Reserve has not proven competent enough to engineer that soft landing. In fact, I think they're quite incompetent. Now, you might disagree with me. You might think Jerome Powell is the greatest thing, and the Federal Board chairman, and all the people he works with, the deputy chairperson, Lael Brainerd, all of them are just brilliant people, and they're going to get this right. Fine. It's not about you believing my forecast. It's about me trying to issue spot on your behalf. Along with rising wages and this great resignation, this unbalanced economy translates into higher than average economy-wide inflation in 2022 and 2023. So they don't get back to 2% inflation next year. Not even close, I don't think. because we have these supply chain issues, and we still have this very strong labor market that they have yet to really begin to deconstruct, to really tear down. And then, yes, so many economists are expecting interest rates to increase. You ask economists anywhere, dry cleaner, movie theater, ballpark, arena, are interest rates going to rise? And we will say yes. And we've been doing that for 40 years. And for most of the past 40 years, we've been incorrect because, well, interest rates have generally been falling for the past 4 decades. It doesn't stop us from saying such things because no one holds us accountable, and that's why I'm an economist. But this year, I feel pretty safe making the statement. The Federal Reserve is very hawkish in its language, and I think they are going to take rates higher. And that, of course, affects people in real estate and construction. And if you're interested in these kinds of data, I have a newsletter, basu.substack.com. If you're not interested at all, please feel free to pound sand. And with that, we have reached the hour, and we are concluded with this webinar, unless somebody from Cherry Bekaert wants to get on and say goodbye.
Thank you, Dr. Basu. We appreciate your time and effort today. Very inspiring and good information. Thank you for sharing your insight and projections this morning.
Thanks all to Cherry Bekaert. Have a great time, everyone. Hope you navigate these economic headwinds neatly, grow your market share, grow your profits, and hope to see you next time. Thanks a lot.